Learning the art of bookkeeping. In this video, we will walk you through the key concepts, essential processes, and procedures of bookkeeping. Let's start with the definition of bookkeeping. Bookkeeping is the process of recording financial transactions of a business. It ensures that your finances are organized and accurate, making it easier to track profits, manage expenses, and meet tax obligations. Bookkeeping plays a vital role in organizing business financial records to make accurate financial reports and to ensure the business compliance with financial regulation. There are two types of bookkeeping method. Number one is single entry system, and number two, double entry system. Under a single entry system, transactions of the business affect only one account, i.e., only one account's value will decrease or increase based on the transaction amount. Under this system, a cash book is prepared that shows the payment and receipts of the cash transactions. For example, a shop owner sells goods worth $500 for cash. On the 21st September 2024, in this case, only the cash transaction is recorded. There's no mention of the decrease in inventory or the recognition of the sales account, which would normally be part of a double entry system. In the cash book, it will look like only the cash inflow is shown, and the transaction's effect on other accounts is ignored. Double entry accounting system. The most important bookkeeping methods is the double entry accounting system. In this system, every transaction affects two accounts, increase in one account and decrease in another account. For example, when a company buys supplies, it decreases its cash account while increasing its supplies account. In double entry accounting system, transactions are typically categorized into assets, liability, capital, revenue, and expense. Assets are economics resources owned by business from which future economics benefits are expected to flow to the entity, such as furniture and fixture, buildings, computers and equipments, cash and bank balances, and so on. Liabilities are future obligations arising from the past events, settlement of which results outflow of resources embodying economics benefits. Capital is the residual interest in the assets of the entity after deducting all its liabilities. Expense is the cost of goods and/or services used up in the process of earning revenue. Revenue is total money earned from the sale of goods and/or services. As you are all aware about the basic equation that left-hand side is always equal to the right-hand side. So as the basic accounting equation, that assets are always equal to the liabilities plus capital. Debit and credit rules are foundation blocks of double entry accounting system. These are based on basic equation, where left-hand side must be equal to the right-hand side. Here are the rules. Increase in assets are recorded by debit, while decrease in assets are recorded by credit. Increase in liabilities are recorded by credit, while decrease in liabilities are recorded by debit. Increase in capital is recorded by credit, while decrease in capital is recorded by debit. Increase in revenue is recorded by credit, while decrease in revenue is recorded by debit. Increase in expenses are recorded by debit, while decrease in expenses are recorded by credit. For the step-by-step procedures, check out our next video on bookkeeping. Here's the contact information of the content creator. You can contact him via WhatsApp and email.